economic implications of this. We still have with us Christian Keller from Barclays. So Christian, getting closer to passing this nearly $500 billion bill, what would that do to the inflation picture? Does this give fuel to the U.S. economy that perhaps it doesn't need?
First of all, this is positive news, and we have been ourselves, and we remain relatively skeptical with the deal coming through. But this seems to be having some impetus. We're obviously coming from numbers that were in the 4 trillion area. Now we are down to a $500 billion, but obviously targeted towards what people would consider the real infrastructure part of it. I think it should help markets to gain some more belief in the longer-term growth prospects of the U.S. If you look at U.S. Treasury markets, they very much seem to be pricing in a return to pre-COVID times with regard to inflation, but also with regard to subpar growth. If I look at real yields in the U.S. now, below 1%, 10-year real yields, if you get that infrastructure package and you believe that really puts the U.S. possibly on a higher medium-term growth trajectory, markets should actually adjust somewhat to that, including in higher real yields.
Yeah, I mean, they should adjust, but I just feel like this bond market has been confounding all of us in terms of the reaction it has to the economy at this moment. I mean, is the real yield at, I think it's about a negative 117 basis points at the moment, is it reflecting the fundamentals, or is it reflecting the continued accommodation from an involvement from the Fed?
I think it's obviously always a bit of both, but on the 10-year, you should argue that it actually, to a large extent, really expectations. Where do markets think, will the economy go over the next 10 years on average? And I think markets now have very much decided on a few things. I mean, A, they do believe that inflation is transitory. That's a very strong message from the data if we see the combination of real yields and nominal yields. And then they also seem to believe that even if the Fed hikes, we always look at when will they start? Will it be 22, 23? But for the market, it's very important also how much would they hike. And we look at Fed futures, they tell us that the Fed will only go to 1.25 percentage points. That's a lot lower than a few years ago still, where markets thought the final rate of the Fed would be. The market believes here inflation will not come back, and all we're going to get is maybe 100, 150 basis point rate increases rather than 400 points or so that we saw in past cycles. And that is a very strong belief, I think, at the moment. It may take a lot for the market to get out of that.
Should the market be more waken up by corporations who repeatedly cite inflation? We had Heineken earlier today, that CEO talking to Anna Edwards, saying that they're going to see more costs up through 2022, higher costs rather. Should that factor more in at this moment?
I do think the market pricing at the moment, that the risks are asymmetric in the sense of there are more risk that markets have to adjust a bit. There are good reasons to believe that there are a lot of transitory elements in this inflation when it comes to car prices, etc. Those should fade out. But we have increasing indications now that some of those supply bottlenecks, some of the cost pressures, as you mentioned just earlier from companies, that they could last into 22. And, I think that puts, in particular, when we look at government yields, that just puts pressure or risks on the upside, yields having to go higher, markets having to acknowledge that inflation may stay a bit higher for longer.
Nothing like a little bit of asymmetric risk on a Monday to wake you up. Christian, thanks so much for joining us today. That's